You know, usually when we think about the architecture of our devices, we tend to focus almost entirely on the headline acts.
Right, the flashy stuff.
Exactly, like the sub-2 nanometer processors or, those massive GPU clusters.
Oh yeah, the stacked OLED screens.
Yeah.
We obsess over the hardware that gets all the benchmark scores.
Right. But today, on this deep dive, we are completely flipping that script. We're looking at a piece of silicon that gets treated like, I don't know, passive plumbing.
Which is a huge misconception.
A massive one. We are talking about memory controllers.
Yeah.
And for everyone holding retail tech stocks, you really need to understand this.
Because it's the bottleneck of everything right now.
Exactly. Think of NAND flash, the actual physical storage where your OS and your data live, as this massive, super busy international airport.
Yeah, you've got millions of data packets trying to land and take off every millisecond.
And it's not just finding an empty gate. NAND actually degrades.
Right. It physically wears down. Every single time you write to it, those little oxide layers holding the charge take damage.
So if you just dump data onto a drive blindly, it'll burn out in weeks.
Literally weeks.
Yeah. So the memory controller is the air traffic controller in the power, but it's also, managing the runway maintenance.
Right. It's doing garbage collection, wear leveling, error correction.
And you completely ignore these chips until there's a catastrophic influx of data traffic.
Like, say, the entire world suddenly trying to build artificial intelligence infrastructure at the exact same time.
Boom. Suddenly, the efficiency of that one air traffic controller dictates if a billion-dollar data center works or if it just throttles itself to death.
It's the ultimate gatekeeper.
Yeah. So welcome everyone to today's deep dive. We have a very specific mission today. We are breaking down the Q4 2025 earnings call of Silicon Motion Technology Corporation.
Ticker symbol SIMO.
Right, SIMO. They are basically the dominant merchant supplier of these storage controllers. And we're doing this talk tickers style, data forward, opinionated, and actionable.
Because this call is wild. It's not just a financial update. It's like a real-time stress test of the entire global tech supply chain.
It really is. We're going to look at the headline numbers, the story driving them, the management guidance, and the bottom line for investors.
And specifically how this insane AI boom is brutally squeezing the smartphone and PC markets.
Yeah, so before we get into the crazy 2026 guidance, let's talk about the macro picture, the storm they're operating in.
The AI ripple effect.
Right, because you can't grasp their Q4 execution without seeing the massive memory drought happening everywhere else.
The scale of it is it's unprecedented. The big AI cloud service providers, the hyperscalers, they are literally trying to lock up every scrap of DRAM and NAND supply through the end of 2026.
And the major memory fabs, the companies that actually print the wafers, they're acting like perfectly rational economic actors.
Yeah, absolutely. They look at these 70, maybe 80% margins on high bandwidth memory for AI, and they just pivot everything.
Right. They're retooling their factories, taking capacity away from normal laptops and phones.
Exactly. They're actively walking away from the consumer market, which engineers this massive artificial scarcity. Prices are just spiking intra-quarter.
Okay, but wait. Let me push back on that logically.
Sure.
If the big fabs are ditching the consumer market and there's a huge shortage of raw NAND flash, isn't that inherently terrible news for a company like Silicon Motion?
You would think so, right?
Yeah. I mean, a controller without memory to control is just expensive sand.
Right. And that surface level assumption is exactly what Wall Street algorithms get wrong. They don't understand the nuance of the module maker ecosystem.
Okay, break that down for us.
This vacuum, left by the big NAND makers, is exactly what caused Silicon Motion's blowout fourth quarter. The consumer demand didn't just evaporate. People still buy phones.
Millions of them.
Right. So third-party independent module makers step in. They buy bare wafers on the open market, package them, and sell them to PC and phone brands.
And those independent guys need controllers.
Exactly. And they overwhelmingly use Silicon Motion.
It's like a gold rush. The giant mining corporations left to chase this massive new AI vein of gold, abandoning a steady, profitable mine.
Yeah.
And Silicon Motion is standing there selling pickaxes to all the independent miners who rushed in.
That is the perfect analogy.
Yeah.
And it shows up directly in the headline numbers.
Let's hit those numbers because they smash expectations.
I'll always smash them.
Q4 2025 revenue came in at $278.5 million. That is up 15% sequentially and over 45% year over year.
They blew right past their target run rate. And the profitability there too. Earnings per ADS hit $1.26.
Wow.
Yeah, and gross margins expanded to 49.2%, with operating margins pushing up to 19.3%.
So they are incredibly profitable. And what about the balance sheet?
Fortress. They have $277.1 million in cash.
Jeez.
And that's after paying out almost $17 million in dividends and purposely buying up inventory to prep for 2026.
Yeah.
They are swimming in cash.
So the story behind these numbers is entirely about market share gains and pricing power, because they are the great equalizer, right?
Exactly. A module maker might buy sketchy NAND from 3 different fabs just to get enough volume. CMOS controller and firmware smooth out all those physical defects so the drive actually works.
Right. So let's look at exactly how this played out in their mobile segment, because mobile was a huge driver. EMC and UFS controllers.
Mobile outperformance was wild. Full year 2025, it grew 25%.
25%.
Yeah. It's now like 35 to 40% of their total company revenue.
That's massive.
Yeah.
And the total addressable market, the TAM, is huge. Over 900 million units shipped annually.
And it's not all phones. That's what's cool. Only about 50% is smartphones.
Right. The other 30% is IoT devices, edge computing, automotive.
Automotive is huge. EVs need industrial grade storage that won't melt.
Right, exactly. But there was this fascinating supply chain detail in the Q&A. Management said 2 major global NAND makers straight up abandoned the mobile storage market this year.
Just walked away, which caused a total panic among phone makers. So module makers started buying localized NAND from emerging fabricators in China.
Okay, but Chinese NAND, it's getting better, but it's not flagship tier yet, right?
Not natively, no.
Yeah.
The error correction isn't quite there.
Right.
But when you pair it with an advanced Silicon Motion UFS controller.
Suddenly it passes flagship validation.
Exactly. CMO is the bridge, making that cheap, localized NAND viable globally.
Now, I did notice one thing. The CFO guided that Q1 2026 gross margins might actually dip slightly, down to like 46 or 47%.
Yeah.
And he blamed this massive mobile success. Why would selling more of a hit product hurt your margins?
It's just a product mix thing. Smartphone controllers are incredible for volume, but the gross margin percentage is historically a bit lower than their corporate average.
Because phone makers operate on razor-thin margins and squeeze their suppliers.
You got it. So when mobile spikes 25%, it dilutes the overall blended margin by a point or two.
But wait, you bank cash, not percentages.
Exactly. The absolute dollar gross profit is massive. It covers their fixed overhead and drives the operating margin up, even if the gross margin percentage looks slightly softer on paper.
Got it. Okay, let's pivot to the PC market, because the PC client SSD market is undergoing a bizarre transformation.
Bizarre is the right word.
Analysts expect PC unit growth to actually decline 5 to 10% in 2026.
Yeah, and it's not a demand issue. It's purely a supply-side pricing crisis. PC makers like Dell and Lenovo are facing punishing price hikes for memory.
Because of the AI squeeze.
Right. The spot price for a normal 512 gigabyte drive has surged.
And PC makers are trapped. A mainstream laptop has to cost, say, $699. If memory costs double, the PC maker either takes a massive loss or
they do what the earnings call revealed. They despec.
They despec the machines.
Yeah. Instead of a 256 or 512 gig drive, they are slapping 128 gig drives in laptops again.
That is insane. It's literally shrinkflation applied to motherboards. The sticker price is the same, but the gas tank is half the size.
Exactly. But here's the crazy part. Even with a shrinking PC market, Silicon Motion expects strong growth there in 2026.
How does that math work?
The transition to PCIe Gen 5, specifically their DRAMless Gen 5 controller.
Oh, right. Because usually a high-end SSD needs a dedicated DRAM chip right next to the controller to hold the lookup map for all the files.
Yes, the flash translation layer.
But DRAM is also in a massive shortage right now.
So PC makers want to sell Gen 5 laptops, but they absolutely cannot afford to put DRAM on the SSD.
And early Gen 5 drives ran incredibly hot anyway, right? Like needing actual cooling fans.
Yeah, they were a disaster for laptops. But Silicon Motion engineered a 4-channel DRAMless Gen 5 controller. It uses host memory buffer, or HMB technology.
So it borrows a tiny bit of the laptop's main RAM across the motherboard.
Yes.
But wouldn't the latency be terrible?
You'd think. But their proprietary data path architecture masks that latency completely. You get near flagship speeds without the cost or heat of local DRAM.
That is a massive win for the PC maker.
Huge. And for CMO, they get to charge a much higher average selling price for a Gen 5 chip compared to older Gen 4 tech.
Okay, so they're wringing great margins out of consumer tech, but the CEO made it very clear on the call that the real long-term money is in the enterprise AI space.
Oh, without a doubt. Hyperscalers have essentially unlimited CapEx budgets. We're talking $1 trillion in infrastructure by 2030.
Right, and AI inferencing needs totally different storage. You're not loading a Word doc, you're streaming vector databases with zero latency.
Which is why Silicon Motion is launching the MontTitan enterprise platform.
Tell me about MontTitan.
It's a two-pronged attack. First, high-performance TLC-based SSDs ramping in late 2026.
Triple-level cell. Good for fast random reads.
Exactly. But the bigger play is the high-capacity QLC-based SSDs.
Quad-level cell. Okay, explain how QLC works because the physics of this are wild.
It is wild. QLC crams 4 bits of data into a single microscopic cell. Think of a standard parking garage where each spot holds 1 car.
That's old-school single-level cell NAND.
Right. Now imagine converting that spot into a fully automated, dense vertical stack that crams 4 cars into the exact same footprint.
Great for density.
But the trade-offs are brutal. To read those 4 bits, the controller has to manage 16 distinct voltage levels.
Oh, wow.
The margin for error is basically 0. If the voltage drifts even slightly, the controller misreads the data. The signal-to-noise ratio is awful.
So traditionally, QLC was too fragile for data centers.
Right. But MontTitan relies on these incredibly advanced digital signal processors and low-density parity check algorithms. It runs complex math in real time to reconstruct the degraded voltage signals before they cause an error.
So they basically fixed QLC.
They did. And now data centers can finally use QLC to replace spinning hard drives.
Because hard drives are way too slow and suck up too much power.
Exactly. And SEMO is already looking ahead. They're preparing to tape out a PCIe Gen 6 version of MontTitan on a 4nm node in 2026.
Wait, 4nm for a storage controller?
Yep, because Gen 6 speeds will push 128 gigatransfers a second. If you built that on older tech, the dynamic power consumption would literally melt the chip.
So 4nm is the only way to meet the thermal demands of the hyperscalers.
Right. They're targeting a massive ramp in 2027 and 2028. Management expects MontTitan to be 5 to 10% of total revenue exiting 2026.
Which is aggressive for a brand new enterprise line. But an analyst asked in the Q&A if enterprise will eventually overtake consumer revenue.
And the CEO preached patience. Because getting validated for a hyperscale data center takes years.
Right. If a laptop drive crashes, you reboot. Annoying, but fine.
But if an AI data center drive drops off the bus, it can crash a whole training workload.
Yeah.
You lose hundreds of thousands of dollars of GPU time instantly.
The validation criteria are just fundamentally different, which actually leads us to the most unique part of this enterprise pivot, the AI boot drive.
Oh, this is fascinating. This completely changes their business model.
Yeah. So SIMO is providing specialized boot drives for the leading AI GPU maker. They don't say the name, but we all know who it is.
Everyone knows who it is.
Right. And they're also working with a top search engine company. They started shipping these in volume in Q4 2025.
These drives live in hostile environments, crammed next to GPUs pulling a kilowatt of power each.
But what blew my mind is that for these specific boot drives, SIMO isn't just selling the controller chip.
No, they are selling the entire fully assembled SSD.
Which means they have to go out into this brutally tight market and buy the raw NAND themselves.
Exactly.
Yeah.
At open spot market prices.
But wait, didn't we just spend the first half of the show talking about how NAND is insanely expensive and scarce right now?
Yes, we did.
So they are volunteering to take on massive margin risk just to build these drives?
Yes, and the analysts grilled them on this. Management expects about $50 million in revenue from this in 2026.
But what if NAND prices spike 20% in a month?
They negotiate pricing quarter by quarter. Sometimes they can pass the cost to the customer, but the CEO admitted sometimes they just take a lower gross margin.
Just to get the business.
Exactly. They are willing to take a margin hit because locking in the dominant AI GPU maker is a massive strategic play.
It's enterprise stickiness.
Right. Once you are baked into the core telemetry software of those AI servers, the switching costs to replace you are way too high.
So it's supply chain chess. Sacrifice upon the short-term margin to win the board in 2028.
Exactly. And that strategic positioning leads right into their 2026 guidance, which is just incredibly strong.
Yeah, let's look at that guidance. Q1 2026 is usually a seasonal slump, right, post-holidays.
Totally.
But they are guiding for 5 to 10% sequential revenue growth, like $292 million to $306 million, defying gravity completely.
And they expect 2026 to be a record revenue year. Sequential growth every single quarter.
They did mention operating expenses will rise in Q2 and Q3 because of the 4nm tape out.
Right, R&D isn't cheap. but operating margins overall will improve.
Now, what about the competition? An analyst brought up Chinese domestic controller makers.
The geopolitical moat. This is so important.
The Chinese government is subsidizing their own silicon design. So isn't that a huge threat to CMO, since CMO sells so much to Chinese module makers?
The CEO's answer was brilliant. He pointed out the structural bottleneck. Chinese competitors can design whatever they want, but they can't get the advanced manufacturing nodes.
Because of the export controls?
Just exactly. To build a fast Gen 5 controller, you need TSMC's 5 nanometer or 6 nanometer process, and that requires EUV lithography machines.
Which China is blocked from buying.
Right. So domestic Chinese designers are stuck using older 22 or 28 nanometer tech.
And you can't build a Gen 5 controller on 28 nanometer.
No, it would be the size of a brick and it would instantly overheat. It's economically unviable.
So Silicon Motion is sitting in this perfect sweet spot. They are a Taiwanese company, so they have full access to TSMC's 4 nanometer nodes.
But they are neutral enough to still sell to all the Chinese module makers,
who then use local Chinese NAND to sell to the domestic market. CMO is literally the indispensable bridge technology.
It really is a masterclass in positioning. They are fully insulated from the trade war friction.
Okay, so bringing it all together, the bottom line for investors, CMO isn't just surviving this AI memory squeeze.
No, they are thriving because of it.
Right. They dominated the consumer vacuum left by the big fabs, squeezed great margins out of PC makers with their DRAM-less tech, and used that cash to fund a huge enterprise pivot.
It's a wildly bullish setup for the next couple of years.
It really is. But I want to leave you, the listener, with a broader thought here, a provocative thought about what this all means for the devices you actually use every day.
Yeah, because there's a real-world consequence to all this.
Absolutely. We are watching the AI industry literally cannibalize the consumer supply chain. PC makers are already downgrading laptops just to hit price points.
Shrinkflation.
Right. So if hyperscalers continue to buy up all the premium silicon and all the advanced packaging and all the high-performance memory for the next 5 years, are we entering an era where everyday consumer devices actually regress?
That's a scary thought.
Will the phones in our pockets and the laptops on our desks have to accept localized hardware stagnation just to subsidize the AI running in the cloud?
If the AI workloads require all the oxygen in the room, the edge device is going to have to learn to hold their breath.
I think you're absolutely right. It's something to mull over the next time you try to buy a new laptop.
Thanks for joining us on this deep dive, and we'll catch you next time.